Okay, good evening, everyone. So this is week number one for Finance 301, and then I'm going to go through the review of accounting. So there might be three videos. We'll start with the income statement, then the balance sheet, and then after that one, the statement of cash flow. So bear with me as we're trying to do this recording, and then I'll walk you through the topic for this week, and then please do make sure to read the book. We'll cover most of the items in the book, but it's also good as you read through it on your own pace. And then if you do have questions with regard to the topic on hand, please do send me an email, okay? So we're gonna go first with the objectives for this week. It's actually to explain the income statement, to talk about the PE ratio, price earnings ratio. That's an important key performance indicator or metric for most investors. And then they look at the income statement for that with some information on the balance sheet. So we'll walk you through that one. And then we'll talk about some financing on businesses. So a business, depending on whether they're on their onset, um, introduction, growth, or maturity, or maybe on the decline phase of the business, they would need to have some capital, right? So initial capital from investors, or it will be a financing coming from banks or bondholders as they grow the business, or as they decline, maybe they need more financing coming from investors to boost them up. So it depending on the stage, we'll talk about the types of financing that a business would need, and then that will either be debt or equity financing. That's an impact on the balance sheet. And then we'll explain why the statement of cash flow is important. We'll explain to you why cash is king. So one thing in finance that is important as a concept is that something as simple as revenue is vanity, income is sanity, but cash is king. So a lot of folks would think about income statement, talk about what's the most important thing in the income statement. Is it revenue? Is it net income? But revenue is just vanity. It's nice to have, but not as important. Net income, after you deduct all the expenses, is sanity, meaning that, hey, you know that you have net income, but maybe it's only based on a accrual basis of accounting. So it does not mean that you have cash. Net income does not equal to cash, but cash is king. So that will be a theme that we're going to be discussing and explaining and tying up as you understand finance. And then also we'll talk about why depreciation provides a tax reduction benefit that increases cash flow, because depreciation by itself is a non non-cash expense. Now, there are three types of financial statements. We have the income statement, then the balance sheet, and then the statement of cash flow. So when somebody explains to you the order, right, of the financial statements, we always start with the income statement. Why? Income statement, you start with sales minus cost of goods sold or cost of sales equals gross profit minus operating expenses. Operating expenses can be general and admin expenses, it can be marketing, selling expenses, and other stuff, right? And then equals net income. That net income is closed against retained earnings. Then that retained earnings is part of the equity account or section of the balance sheet. Then the difference between two balance sheets, 2 years of balance sheet, year one and year two, will be the changes that will be shown on the statement of cash flow. So that's the reason why when somebody would talk about what are the different types of financial statements, there's always an order, right? Income statement, net income goes to the retained earnings that is part of the equity section of the balance sheet, assets, then liability, then equity, balance sheet, and then 2 years of balance sheet, say year 2024, December 31, 2024, minus December 31, 2023 movements. Those two movements would actually be your statement of cash flow. Okay. Now, what does the income statement do? They actually basically cover profitability. It tells you profitability. It tells you how the business um, performed based on its core activity. If you're selling a product, how much have you sold? And then as to the amount of revenue that you actually realized, how much was it as gross profit? And then to the point wherein you can say what's the net income. So we'll do an example so you can take a look at it. And I'll use the pen here, so bear with me, or I'll do the laser point. Okay, so this is Kramer Corporation, and then it's a 2021 income statement. So not a typical income statement. I will say that as a first observation. Reason why? Because normally when you look at the income statement, you would have, you would not see the word EBIT and then EBIT, earnings before interest and taxes, and also earnings after taxes. We have that open close parentheses, right? Why? These are mostly finance terms, not accounting terms, but I know income statement is actually a accounting report generation. So what am I doing a delineation on that one? Let me explain. As we said on the introduction for this course, right, the report that is being used by financial analysts, those doing finance, is actually the income statement or the financial statement. Those financial statements are accounting for historical information of a corporation or a company or an entity that is accounted for and generated by accountants. Now, the financial analyst would use those financial statements to see and forecast a potential value of the company, its projects, its own balance sheet. So, finance, future looking, accounting, historical recording or historical reporting of information. So that's one thing that's important. So that's why EBIT, EBT, EAT would not normally show on the audited financial statements. Some would do. For my corporation that I work with, we shows earnings, but we spell it out: earnings before interest, taxes, depreciation, and amortization. We call that as a non-GAAP key performance indicator. We'll explain more on that one in the later chapters. But for now, let's take a look on the review of the income statement. So you have 2 million of sales. 1.5 is actually cost of goods sold. If you deduct sales minus cost of goods sold, you have 500, right, as your gross profit. And then now the operating expenses, which will be your selling and admin expenses, to 79.5, depreciation also 50K, and then interest and then taxes. If you deduct that, it will be um, $110,500 of earnings after taxes. Other terms, it's net income after tax, right? So here, we extended the income statement by deducting the dividends to pay to the preferred shareholders. And so that will be the 100,000, the earnings available to common shareholders. If I divide it by the number of outstanding shares for common shareholders, then basically the earnings per share, EPS, is $2. Now, let me make sure that we break it down because we introduced something new. We have preferred dividends, and then we have common shareholders right here. Now, remember when you do financing, you can actually ask for financing from investors. Now, investors can either be a preferred shareholder or a common shareholder. So what's the difference? Now, for example, the common stock might be a $100 par value, but if you are given some preferential treatment, the corporation can say, hey, I will pay first dividends, or I will declare and pay dividends first for the preferred shareholders, but you need to pay the value of 150 compared to a par value of 100 for common stock. But for those who would like to just buy 100 par value, then it will be the common stock. Or sometimes they would issue preferred shares only for a selected institutional investors, selected few, but everybody else will be issued with common stock. So that's why they have that different types of stocks, right? And then you have earnings per share $2. Okay, so um, when you think about, let's do the practical side. We went through the basically the technical side of this meaning of the income statement. When I look at that one, so um, you have 500. Let me just take a look for my item here. I don't have it. So when you look at it, for every $20, we'll just say for every 20, well, we need to make sure it's actually smaller, right? So we always say we need to unitize the income statement in order for it to be more relatable. So let's do it this way. It's 2 million. So let's do a unitization. Make it a bit easier. For every $2,000 worth of sale, just like we'll drop the three zeros. For every $2,000 worth of sale for Kramer, they make as gross profit $500. We basically drop the three zeros. So now it makes it more relatable if we unitize it that way. We can do it by a percentage or a dollar, but that will be a bit harder, right? So what happened is that for every $2,000 worth of sale, you basically make 500 as gross margin or gross profit. Why? Because 1,500 is actually your unit cost. Okay. But at the same time, that 500 that you made as gross margin, you need to deduct 279 to sell it, and then to sell it, and then some admin stuff that you incur. Admin might be HR, legal, finance, or any admin cost. So you would end up to be $170 out of that 2,000 revenue. But not only that, I need to deduct 20 out of the 170 from your 2,000 revenue, and then now it will become 150. But I need to deduct taxes of 40, so you're now left with $110. So we'll just unitize it. $110 that you're left behind from a $2,000 sale that you started with a 500 gross margin. So when you talk to somebody about a corporation's income statement and then you unitize it that way, it makes it easier to digest, right? So when you think about it, yeah, I made 2000 this month. Well, wait a minute, I know its revenue is 2000. That is basically what we call vanity. But your net income is 110. Okay, $110, that is actually some sanity, but you don't still have cash, right? Because why so? Because out of that 2000, so what's the entry when you record revenue? If you remember your accounting, that will be AR or cash, depending on, or a combination of, but let's just say it's AR, sales on credit, AR, credit revenue. So not everything might have been collected out of that 2000. So that's why your 110, a portion of that might not have been collected as cash or realized as cash. It might still be an accrual. So that's why net income does not equate to cash. That's why cash would always be king. Okay, so that's something that we would like to make sure that we understand early on, right? Now, let's go to the next page. It's a recap of the importance between um, the gross profit, which is actually sales minus cost of goods sold, and then here is the EBIT. EBIT is earnings before interest and taxes. That's the gross profit from here, minus the expenses, which are the operating expenses, selling and admin, and then also the depreciation. And then EBIT minus the interest will now be earnings before taxes, minus taxes will be earnings after taxes or net income. Some companies they call it NIAT, net income after tax. Now, um, return to capital. There are three primary sources of capital. So what are we talking about? A company, when you establish it, would need capital. Either you fund it yourself as initial partners or initial contributors or incorporators of the business. So that will be equity coming from you, right? But as you grow the business, if, for example, it's a private organization, as you grow the business and then you would like now to uh, issue or you would like now to go big, basically you want to go to an IPO, an initial public offering. What do I mean by an IPO? An IPO means that you would like now to list your business with the US government or with the Security and Exchange Commission. Or another way of saying it is that you would like to list yourself to the NASDAQ, the Dow Jones. Now, if you do that, then it means that you would need to be issuing stocks through a issuance of stocks like Apple. They are a listed company, a public company. um, Toyota and other companies, the Tesla or Microsoft or the big fangs, right? Well, now it's Meta. So before we call it fang stocks. Facebook, Amazon, um, Netflix, and then Google. So those are the big stocks that they call the FANG stocks, right? But of course now Facebook is Meta. Um, so those are basically having the stocks or equity financing. Now another way to get funding, and then before I go there, the question is that why do we need to get funding outside of the initial capital by the initial incorporators? Reason why? You want global expansion. You want to actually go bigger. Um, Global expansion, or maybe just an introduction of new products and services, wherein you would like to create your own manufacturing plants. So you have vertical integration or whatnot. And then those require capital. And then sometimes asking the bank for loans might not be enough, or asking investors might be the better way. So the other way, other than equity financing, is actually going issuing bonds to to bondholders. Basically, you are selling, the company is selling bonds, and then people will buy the bonds who are called the bondholders, and then you, the company, would now be required to pay on a semi-annual basis, depending on the way that your bond policy is set up, to the bondholders. So that is called debt financing because the company will be incurring debt in order for you to get capital coming from bondholders. Or another way of debt financing is actually getting a loan from the bank, right? But in big cases, it would be a bond holder or issuance of bonds. Now, earnings per share is basically your earnings after you pay your preferred shareholders, and then divided by the number of common stock that you issued, and then it's interpreted in terms of the number of outstanding shares, like we've seen with Kramer on the examples a while ago. It may be paid out in dividends or retained by the company for subsequent reinvestment. Now, I inserted on the PowerPoint slide from the book something that I use also to talk about debt and equity financing. So on column B, if you can see, column B actually shows you the um, debt financing, and then column C is equity financing. So both are 100%. Now, when you think about debt financing, you are obligated to make a payment of interest to your bondholders. Or, in the same way, you are obligated to pay interest to your bank, because if you have a loan, which is a form of debt financing, you need to pay, right? And then equity financing, I put there NA. Why? Because you can tell your shareholders that you're not paying right now you're not paying them through a dividend. You're not declaring dividend because you would like to reinvest the net income back to the company to fund capital improvements project, basically capital expenditures like building a warehouse, buying more stocks, inventory. I mean, like stocks like inventory, and then funding your own expansion program rather than doing debt. So that's why net income after tax under 100% equity financing is higher compared to debt financing because why? Uh, you deduct interest expense from the net income, right? Because interest expense is expense. So somebody would argue by this point, so it's not good to incur debt. Actually, not really a straight answer, right? Why? Equity financing. So let's ask this question. Among the two, a bondholder and a investor, who do you think asks or demands more? Like demands more interest. So I would say it will be the equity investors. They have a higher expectation than the bonds. So let me ask this way. If you hear about the stock market or you heard your parents or your friends or your relatives talk about the like investing, so people would say bonds are safe but lower interest because those are bondholders. It's safe. It's like if they buy treasury bonds with the backing of the U.S. government, right? And then but equity is actually very volatile. You can earn today and then lose tomorrow, depending on how the market reacts, right? So investors ask a lot. That's why the interest, when you think about it, the cost of capital through equity financing is much higher compared to bond financing. And as we would learn in the next few weeks, incurring debt or being levered, so that's a new word, being levered can be a good thing because it would actually have an impact on how you calculate return of equity. We will go back on that one. Just right now, I'm flagging it so we can actually go back and then connect it when we're there. Okay, so for now, good for us to understand what's the difference between debt and then equity financing. Now, what happens again with the net income? The net income, remember we have 100,000, right? The net income that's been realized by Kramer would actually be closed or carried over to the retained earnings section of the balance sheet. So that's why this one is the roll forward of that one. So 250 beginning retained earnings plus 100, 350 minus 50, which is the cash dividends, is 300. Now, what's retained earnings? Retained earnings, when you look at the balance sheet, it tells you the accumulated net income after you deducted dividends. That's basically the retained earnings end. You could not declare a dividend if you don't have enough retained earnings. You only declare dividends if you have retained earnings. So that's one thing, that's a rule, right, on dividend declaration or dividend payouts, which we have a chapter on that is actually important also to note. Now, I'm going to go here. Um, Price earning ratio. So we're going to go to the price earning ratio formula. Price earning ratio is a key performance indicator or a KPI. It's a multiplier applied to earnings per stock per share to determine the current value of the common stock. So price earning ratio or PE ratio is actually used to understand whether a stock or a company stock is a value stock or a growth stock. We'll talk about it more later. And then it actually gives you an idea of how is the stock performing based on the PE ratio. Now, PE ratios are being used as a benchmark, meaning when we say benchmark to compare, right? to compare with a company within your industry, or as people would say it, compared among your peers within the industry. Now, firms with the higher expected returns have higher price earning ratio. So, say Netflix has a high PE ratio, and then it's a it's a performing stock, right? But at the same time, PE does not tell you the whole story, but it's only a gauge of how the business is actually doing. For Netflix, Netflix has a high PE ratio, but when you think about it, it also incurs a lot of debt because they need to produce the movies, they need to, or the series, the movies that they self-produce, they fund that through a lot of equity financing, through a lot of borrowing, and then that shows on their balance sheet as a liability or equity. And then we know equity financing, expectation of dividends, because it's not mandatory, right? And then if it's actually a debt financing, then a mandatory payment over a period of time of interest expense. Here's an example of price earnings ratio, but I would want to actually go through a section on um, the calculation itself, right, or the formula. So I have here, I pulled it out, so I added on our book's slide deck or PowerPoint. So I'm gonna maybe reload it, or I might just use the video for that one because I added a few more from what we have because I've seen this one online that are useful. So I pulled it out for the Corporate Finance Institute, or CFI, the PE ratio. So the formula is share price divided by EPS. So we know what's EPS, right? Earnings or net income after tax, then divided by the number of outstanding shares. So let's go through it. PE ratio is the relationship between the company's stock price. So basically, what's listed on the market if you want to buy the stock that day, and the EPS, or the earnings per share. It's a ratio that gives an investor whether the stock, what's the value of the stock, and it shows the expectation of the market of the price that you pay based on the current earnings of the business. So it can also be future earnings, right? Because some people would want to buy because they want to invest. So it can be the future side of things. So the basic formula takes to the account on the stock price to find the current PE. EPS is found by taking the earnings from the last 12 months divided by the weighted average outstanding. Now, you would say, hey, EPS, or the PE ratio for, say, a Yahoo stock or Apple is being posted every month. But remember, for us, 1 year is actually January to December. But what if it's February now? So it's basically from February all the way to January of last year. If it's March, it's actually March all the way from February of last year. Yeah, because it's a rolling income, right? It's always 12 months. So that's why there's a science on how to calculate, well, a formula, not really. It's a formula, not too complicated, of how to actually calculate it. And then for the month of March, here's your stock price, shares price divided by the earnings, which is basically 12 rolling months divided by the number of outstanding shares. That's why it's earnings per share. Now, during COVID, there are a lot of one-offs, a lot of write-offs, a lot of things that is not normal to the business. So anything in the income statement that are one-offs. So one-offs in finance, we call it one. Those are doesn't happen every day, but these are extraordinary events that we can take out and not consider, but we need to declare what are those one-offs, and then call that, after deducting that, we will call it as a normalized EPS. Now, I like this one because it brings out, or it gives you an understanding of what it is, right? So when we unitize a PE ratio, like say it's 1:1, It's like price is the same as the EPS. So that will be a price of 1. Now, we will now take a look on two scenarios. It's a low PE ratio. Why? Because the price is here and then the EPS is actually on almost the middle part. So like I say 0.4, right? So this is 1, this is 0.4. Unlike here, it's actually 1 over 1 is equals to 1. So 1 over 0.4. It's a low PE. But here, it's price divided by an EPS might be 0.3. I'm just like doing it by scale, right? So when your numerator then divided by a point, because it's actually not a whole number, 0.3, then it will turn out to be a higher PE compared to the 1 over 1 divided by 0.4, right? So those with high PE, this scenario, are considered to be growth stocks. This indicates a positive future performance and investors have a higher expectation of the future earning and are willing to pay more for them, right? So your stock is trending higher and then your EPS is actually on this side, so it will be a high PE. So the downside is that there is volatility on the stock. For this reason, it can be considered as a risky investment. Now, on the low PE side, which is this one, we call that as value stock. The other one, high PE, growth stock. So this one is low PE, which is actually value stock. It means it's undervalued because they're traded lower compared to the fundamentals. Fundamentals meaning that the basics of the business, right? The profitability, how's their governance. There's a lot of qualitative and quantitative sides on the fundamentals. Now, examples of P stocks can be found with industries that would actually be mature enough and then will give dividends. Like say, at one point in time, General Electric is listed, they delisted, so they provide a lot of dividends. So GE is one of those. Now, what I'm talking about of high and low PE. So this one that captures it all, right? So we have a stock A and then stock B. Now, when you look at it, stock A has a $30 shares price per share, and then stock B is $20. Now the EPS is $2 for stock A, so 15 times is the PE ratio, and then stock B is 0.67 earnings per share, so it's actually 30 times the ratio. Now, how do you review it? So here's what's happening. The outstanding number of shares for stock A is 250,000, and then stock B is actually 280,000. So this side shows that who's actually the high PE? This one. Does it actually have a high? So we call this the growth stock. But when you think about it, the growth stock is only making 187 in earnings compared to a PE ratio of 15x lower, right? So we call that value stocks. But the net earnings is actually higher. What's the difference? It's the number of, well, it's basically the earnings per share and also how the stock is actually being traded in the market. So what we're trying to say, a lot of folks would, or it's a guiding rule, a rule of thumb, but not the ultimate rule, is to go with a high PE ratio when investing. One of the things that you need to take a look at, not the only thing, but you would need to take a look at it on a industry average, 15x. So that's why stock A is still good at it. But you can tell that stock B is performing more on PE ratio compared to stock A. But you can tell also that right now, earnings for stock A is better compared to stock B. Depending on, because stock B might be too aggressive with their future growth and it's incurring a lot of debt That can debt can be can debt incurs interest. Interest is deducted to net income, so it can be an explanation. That's why we always say PE ratio is good to take a look at, but it should be looked at as in a combination of other ratios. uh, Return on equity, return on capital invested or invested capital, ROIC, ROA, return on assets, which we are all going to go through. So don't worry about that. Right now, we want you to be aware what's a PE ratio, what it tells you, and then what it does not tell you also, because you would need other information from other financial ratios in order for you to do a full analysis. Now, here is the explanation for that one. Stock A is trading at 30 and stock B is at 20. Stock A is not necessarily more expensive. The PE ratio helps us determine from a valuation perspective which sector is cheaper. If the stock average or industry average is 15, stock A is 15 already on your PE ratio, and then stock B is 30. Stock A is cheaper despite having a absolute price, higher price than stock B because you pay less for every $1 of current earnings. True. However, stock B has a higher ratio than both its competitor and in the sector. That might mean that investor is willing to expect higher earnings growth in the future relative to the market. So that's why a lot of investing is basically trying to see or trying to investing is basically a lot of forecasting, a lot of taking a gamble, right? That's why it's investing it, especially on equity stocks. So we talk about the income statement, we talk about the EPS, how it's calculated. We relate the EPS as part of a formula calculation with regard to the PE ratio. And then we know the limitations of the PE ratio and how it's being looked at. And then we now go to the limitations of the income statement. So income gained or lost during the given period is a function of variable transaction. So stockholders may perceive smaller gains or losses from day-to-day operation. And then there are similar or flexibility in reporting transaction can result on different measurements of income gained from similar events at the end of time period. So what we're trying to say here is that there are a lot of transactions that happen on an income statement because you actually in finance, you look at it on a monthly basis. You forecast things on a monthly basis. Every month, there's a lot of changes. There are a lot of normalization that happens when you report to year to date. And those normalizations are based on one-offs or extraordinary items that you would want to make sure that you understand, right, when you're valuing. Um, Later on, you would understand what I'm saying when we say valuing, because we will try to value a company based on reviewing the key performance indicators of a business. So that is actually our chapter on the income statement. The next video will be on the balance sheet.